Well, we think the RDR is a really important step in the right direction. Commission bias has been a blight for consumers for many decades. Consumers getting sold products that are simply unsuitable for them because they pay really high rates of commission to the people selling them. And the banks have been the worst offenders at this, but there's plenty of bad practice in the IFA world as well. And RDR looks like it's going to put a stop to that once and for all, which is really great news. But of course that's only half the picture, because there's still stuff that gets sold through the non-advised channel in banks and building societies, such as structured deposits, which we have a number of reservations about, and of course sales incentives for bank and building society staff are not going to be covered by the RDR, and so we fear that we're still going to get bank and building society branch staff selling structured deposits to customers whether or not they're suitable. So we'd like to see sales incentives tackled with some urgency by the regulator, but also see products like structured deposits moved into the regulated advice regime so that, RDR really does have the effect that it's intended to. So RDR solves the problem of commission bias. What it doesn't solve is the issue of the millions of consumers that just aren't getting financial advice at the moment. There are many affluent, semi-affluent people who are getting served by the IFA community. There's other people who are getting served by the debt charities and the debt management companies. And then there's this enormous population of people in the middle who are not getting any financial advice at all. Some of them quite affluent, but they have no confidence in advisors, no confidence in the industry, and so they don't want to seek advice. And unfortunately RDR won't address that. We think that one of the potential ways that the regulator and industry could think about trying to address that is getting into the workplace. Actually that's the time when people are starting to think about their pension arrangements and saving for retirement. Maybe that's a good time to start them thinking about their financial needs in the round. Unfortunately that's something that the Torreson report didn't really look at. So there's an opportunity there, but unfortunately RDR isn't going to solve that problem.
I think the RDR is going to have a brilliant effect on financial services, because for the first time the public will be able to see that there are a new breed of financial planners that they can trust, who make their money from fees from clients, who are working for their clients' best interests, not taking commission from providers, and those advisors will be more highly qualified than they were before. And they'll be advising across the whole market of retail investment products in a way that they weren't previously. The Retail Distribution Review is having a fundamental effect on financial services, because what it's doing is moving the entire industry away from a sales culture, a transactional approach where they're flogging product basically, to one where they are talking to customers about their problems, about their individual needs, and offering them solutions. So it's less hunter, more farmer, it's more caring, it's more holistic, it's very positive. The Retail Distribution Review has been a massive regulatory effort from the Financial Services Authority, and going forward from 2013, particularly after the failings during the banking crisis and the credit crunch, it is imperative that the new regulator replacing the Financial Services Authority is tough. It does its job very well. It's really on the case with the firms it regulates. But there's a massive aspect around ethics in Retail Distribution Review. What we're trying to do is create a new breed of trusted advisor, whether that advisor is in the bank or an insurance company or is an IFA, that you actually trust that they are good at doing their job. And when you start thinking about trust, it's no longer just about ticking boxes and complying with rules. It's complying with the principle that the FSA had of a long time, treating customers fairly. And fairness requires ethics. And I think from 2013 each advisor will have to have a statement of professional standing, and one of the really significant things about that they'll be committing to a code of ethics. And I think the whole industry, providers and advisors, need to think much more about their ethics, so that we're not constantly chasing them. Are you complying with that rule? We want to trust them. Are you doing a good job? Can people trust you?